open, and welcome all members of the Standing Committee Finance. Welcome officials from Treasury, from entities that report to Treasury. Welcome the support team from Parliament, the Secretariat, research, content advisors, legal, PBO, and others. Are there apologies?
Yes, Chair. As Mr. De Villiers indicated, Dr. George sent through an apology for Mr. Maswali as well.
Okay, let's record those apologies. Then let's move to item 2. Response by National Treasury to submissions received on the Financial Matters Amendment Bill B20 2022. National Treasury, over to you.
Good morning, Chairperson. MP van Schoof from National Treasury. I will be presenting on the responses from Treasury on the public comment, and also we received assistance from the Government Pension Administration and also the Independent Board of Regulators for Auditors. And with your permission, I want to ask if you can also deal with the letter that the Minister of Finance wrote to the committee on the 5th of April that pertains to 2 of the amendments in the bill. So it's at the end of the comment matrix. Now, firstly, the comment that we received, sorry, I'm trying to move. We received a comment, or the committee received comments from 3 institutions. Firstly, the Association for the Monitoring and Advocacy of Government Pensions, COSATU, and also Deloitte. So I'll deal with these comments now and our responses. Apologies. Now, the first comment is from COSATU, well, essentially supporting, because you might recall that the bill contains amendments to a couple of pensions laws, and one of them is the Military Pensions Act. And the proposal in the bill is that we extend the provision for life partners in a way that it backdates to the date that the interim constitution took effect in April 1994, and they essentially, let's say, they support this amendment. Now, the next amendment that COSATU might comment on is the incorporation of the association institutions pension fund into the government employees pension fund, and one of the one of the consequences of this would be that the clean break principle would also apply to members of this fund. There's also another fund which we did indicate, the temporary employees pension fund, which there's some technical amendments to align terminology referring to the relevant ministers and departments. But the incorporation of this fund into the GPF there's no legislative requirement or a necessity for that. So that is done separately. But we did update the content of that act to align to the current administration of this act. Then a comment also on the pension-related amendments from the Association for Monitoring and Advocacy of Government Pensions Funds. They requested information about the financial stability of the 2 funds that I mentioned. And you would recall at the time that you directed us to provide them with the necessary information. We did supply or provided comments to the documents to the committee secretariat, which I understand was forwarded to the member, which included details of the membership of these funds and the employers, statutory evaluation reports of both funds, and also the actuarial report on the financial implications of the amalgamation of these funds into into the GPF. And just to summarize the implications, now the Employment Pension Fund membership is 2,353, so it's quite a small fund, and the TEPF is even smaller. It only has 8 members, while the GPF has more than 1.4 million members. Now, both of these funds are fully funded institutions, and have asset values above 100%, the funding levels. So the amalgamation of these funds into the GPF will be positive for the GPF if all the reserves are transferred to the GPF, which is as recommended by the actuaries that did the report. So that's the implications of these two funds, the amalgamation into the GPF. Then the next amendment that we received a comment on is from COSATU. Now, COSATU, there was a couple of amendments in a bill relating to the audit profession that COSATU indicated that they do support, but they raised the issue of the mandatory audit rotation rule, which they submit should be contained in primary legislation. But the IRBA did issue the rule, a rule which is effective from 1 April 2023. So it's now currently under implementation. And the rule requires that audit firms of public interest entities shall not serve as an appointed auditor for more than 10 years. Then after the 10 years, there must be a 5-year break before they may be appointed as an auditor of that entity. Now, obviously, the IBA will monitor the compliance with this and address any transgressions. Now, as indicated at the previous time the Audit Profession Act was amended, we did indicate that there's a broader review of the Act underway, and that the amendments contained in this bill is only urgent amendments that we wanted to propose to Parliament, and that the proposal to incorporate this rule into prime legislation will be considered when this broader review of the Audit Profession Act is undertaken. And then comments will also be sought at the time before tabling in Parliament. Then, yeah, that's also the next on the comment matrix also relates to the mandatory audit rotation rule. Then the next set of comments came from the Lloyds, which pertains to the also to the Audit Profession Act. Now, the first one relates to the question that I have about the sanction. Now, the rule is that if there's a transgression and it's similar to criminal offences, that you can only impose the sanction that's applicable at the time of that the misconduct occurs. And Deloitte was querying because they said it seems that this only applies to where the particular matter is subject to a hearing process, and not when there's other admission of guilt process, because there's two processes in the Audit Profession Act. The one is admission of guilt process that goes to the Enforcement Committee, and then there's also a disciplinary process for more serious sanctions. So we're just confirming in our comment that it's indeed the case that the sanctions that may be imposed either by an Enforcement Committee or disciplinary hearing process can only be sanctions that was applicable at the time of the alleged improper conduct occurred. And there is a provision in the 2021 Audit Profession Amendment Act that I'm just scrolling to it, which actually confirms that it's this part that I'm highlighting, that is the case. Then the next comment from Deloitte was in relation to clause 22, where we propose transitional measures in regarding disciplinary processes. They are asking and said that there's insufficient information as to the disciplinary framework that is applicable, and they need more clarity. Now, firstly, I want to note that the amendment to clause contained in clause 22, the Minister of Finance in his letter to the committee requested that the committee reject this amendment, and I'll explain more about it when I deal with the letter at the end. Now, the next question from Deloitte was, or the comment was that the authority of the enforced committee to determine if conduct warrants deregistration or disqualification, which are the more serious sanctions, that's not been determined according to their knowledge. Now, the bill does in section 49 provides that the enforcement committee may consider whether what is the possibilities. Now, the first possibility is that sorry, apologies, is that that the referral to the disciplinary committee will occur in 2 instances, and that's not by the enforcement committee. If a respondent does not or fails to admit to guilt, or the view is that of the enforcement committee is that the improper conduct of an auditor warrants a sanction that is either deregistration or disqualification from registration as an auditor. Now this, our view is that that's the position in terms of the current legislation, but there has been some concerns that it's not sufficiently clear. So the proposal in the bill in clause 21 is to make this absolutely clear, that the enforcement committee could, if it believes that it warrants these more serious sanctions, refer the matter for consideration by a disciplinary hearing. Now, the important consideration is that whether the particular improper conduct indeed warrants the registration or disqualification will still be a decision by the disciplinary committee. The mere fact that the enforcement committee thought that it might warrant it, that's not a determining factor. It will be considered by the disciplinary committee following the process that they need to follow. Then the last comment, or another comment from Deloitte, was there is maximum fines that the Minister of Finance must determine by Gazette, and they're asking about those that determination. Now, a public comment process was followed to obtain comment on the proposed maximum fine. And currently that was considered, and currently this is under consideration by the Minister, and it's expected that quite soon the Gazette to determine these fines will be published. Then this is an amendment that I already indicated earlier, clause 21, where we want to clarify that what the enforcement committee might do if they think a sanction, the warranted sanction of deregistration or disqualification is warranted. So I'm not going to repeat that because it's dealt with. I dealt with it earlier. Then the Deloitte also asked about the IRBA sanctions framework, and that's not finalized. Now the IRBA indicated that the draft implementation framework can only be finalized once the Minister of Finance has determined the maximum monetary fine. And once that is done, the framework will be finalized by the IRBA. So those are the public comments that we received, Chair. Then the second part of the the document is just a brief summary of the letter that the minister wrote to your committee in April. Now, the bill also contains an amendment to the Financial and Fiscal Commissions Act to remove the role of the secretary, of the role of the CEO as the secretary of the commission. Now, this proposal to amend the Act was requested by the FFC, but we subsequently realized that this amendment must be in a 76 bill, that's tagged 76 bill and not a 75 bill, and therefore request the committee to reject this amendment, and that when we prepare a bill that should be tagged as a 76 bill, this amendment will be included in that bill. And we did advise the FFC about this situation, so they acknowledged that. Then the next amendment, which I briefly referred to earlier, is the amendment that's contained in clause 22 of the bill that relates to a substitution of section 23 of the 2021 Amendment Act. Now, the proposal or the provision in that bill essentially said that improper conduct not dealt with before the effective date of that Amendment Act must be dealt with by the same structures that was applicable at the time. Now, this was not practical, and IRBA wanted the new structure to deal with those committees, with those matters, sorry. So the proposal was that in the bill is that the new structures and following the amendment of the 2021 Act should deal with these matters as well. But obviously, as indicated, they can only impose the sanctions that were applicable at the time. Now, since the IBA was anxious to proceed with the cases that they had from that time, and there are 16 of those cases, sooner, they sought advice from senior counsel to advise whether there's not a different way of dealing with matter, and the senior counsel advised that the IRBA may establish a transitional disciplinary committee to deal with these historical cases or old cases, and therefore there's no longer a need to amend section 23 of the 21 Amendment Act. Therefore, it's also, we've considered that and we agree with the proposal made by the IRBA in view of the senior counsel opinion, and therefore the minister also requested that the committee reject the amendment to clause 22 of this bill. Thank you very much, Chair. That is the presentation from my side.
Thanks very much, MP, for the presentation. Are you done from the side of Treasury so that we can move to the next item? Hello, Treasury, are you done with presentation?
Yes, Chairperson, unless maybe can I just check if the IRBA colleagues wants to add anything? Sorry, it doesn't look like it. Sorry, Imre, sorry.
Good morning, Honourable Chair and members. MP, nothing from our side at this stage, but if there's any questions, I have both the directors and myself available to answer questions.
Okay, let's move to item 3. Honourable members, there we are. That's the presentation from Treasury on the response in regard to the submissions that were received. Are there clarity-seeking questions and/or comments? So far, I don't see any hand on the platform. Okay, we are okay. If honorable members are satisfied with the response by Treasury, let's move to the next presentation, the response by National Treasury to submissions received on the Municipal Fiscal Powers and Functions Amendment Bill, B21-2022. Back to you, National Treasurer.
Thank you, Chair. My name is Machweni Mpiana. I'll be taking you through the presentation on the National Treasury responses to submission on the Municipal Fiscal Powers and Functions Amendment Bill. Let me quickly share this presentation. So the presentation is in three sections, and I'll be focusing on the submission that we have received from SALGA, and Sandra will come and present the last two submissions. The first issue that was indicated in the submission was that SALGA proposed an alignment of the definitions between the SPLUMA and the definitions contained in the Municipal Fiscal Powers and Functions Amendment Bill. National Treasury agrees with SALGA's proposal, and the bill has been amended to align its definitions with those contained in SPLUMA. For example, in Section 1 of SPLUMA has been amended by providing additional definitions, and these amendments have been consulted with the Department of Rural Development and Land Reform, and they were supported. Additional definitions that were included relates to the bulk engineering service and the link engineering service, and these definitions are portions of what constitute external engineering service. Other definitions are aligned to those in Section 1 of SPLUMA, such as external engineering service, internal engineering service, and applicant. Furthermore, the term landowner has been replaced with the term applicant, and the definition is similar to the one contained in SPLUMA. The bill no longer refers to municipal engineering service, but to engineering service, and the definition is similar to the one in SPLUMA. Municipal service and municipal engineering service are those services that municipalities are mandated to perform in terms of Part B of both Schedules 4 and 5 of the Constitution. Then SALGA also indicated that they were asking whether the bill implied the levying of municipal surcharge for municipal services in general, and also the levying of development charges for municipal engineering services. So our response is that no, the proposed amendments to the bill do not deal with the levying of municipal surcharges for municipal services in general, but it deals with the levying of development charges for municipal engineering services. So the municipal surcharge may be levied on fees for municipal services in general, and the definition for the surcharge has been defined in the Principal Act, that is the Municipal Fiscal Powers and Functions Act 12 of 2007. then this municipal surcharge, it has no bearing on the development charges, and neither does the development charge have a bearing on the municipal surcharge. A municipal council may levy a surcharge for any of the municipal services outlined in Schedule 4 and 5 of Part B of the Constitution, but it must be noted that apart from amending Section 1 of the Municipal Fiscal Function Act 12 of 27, the bill inserted Chapter 3A, which deals specifically with development charges, and the rest of the chapters in the Principal Act haven't been changed. Development charges can only be utilized for providing infrastructure, whereas surcharges may be utilized at the discretion of the municipality. SALCA also wanted National Treasury to be more clearer in terms of the status of development charges, whether it is a levy, a tax, or a charge in terms of the Municipal Systems Act, and tariffs, or is it a surcharge? So National Treasury agrees that the status of development charges must be made clear, and the bill states that development charge means a charge. So it is not a tax, it is not a levy, it is not a surcharge, it is not a tariff, it is a charge levied by municipality in terms of Section 9A1, subsection A, and contemplated in Section 49 of SPLUMA, which must contribute to the cost of capital infrastructure asset required to meet increased demand for existing and planned engineering services, must contribute towards the cost of open parks and spaces in the land development application. If the land development application provides for the use of land for residential purposes, or with the approval of the minister, contribute towards capital infrastructure assets required to meet increased demand for other engineering services not prescribed in terms of SPLUMA. So see there just to clarify, currently municipalities are levying development charges on other engineering services, and you find that there are other engineering services which do not form part of the engineering services as outlined in SPLUMA. So municipalities will be expected to submit an application for the Minister of Finance to approve additional engineering services for them to be able to levy development charges on. Then municipal surcharges and taxes have been clearly defined in the original act. I've already alluded to this. Then to avoid confusion, the Municipal Fiscal Powers and Functions Bill under Section 3, subsection 2, clearly indicates that chapters 2 and 3 do not apply to development charges. And as such, the bill deals with the application and regulations of development charges and nothing else. SALGA proposes that development charges should be recognized as a non-trading revenue in the statement of financial performance. National Treasury agrees with the proposal from SALGA, and this matter relates to the previous version of the bill that was published for public comments, and the section relating to accounting and reporting has been removed from this version of the bill. Municipalities will account and report on development charges in accordance with existing legislation, such as the Municipal Finance Management Act. And in addition, National Treasury will issue a circular or notice to provide guidance on how municipalities should account and report on development charges. So in the current bill that is in front of our Parliament, there is no section that deals with accounting or reporting on development charges. Then subsection 9A, 1C of the previous bill, there was a provision that development charges must be imposed by the competent authority. So SALGA is of the view that this might be a constitutional matter in terms of section 229 and 160 of the Constitution, as only a municipality may impose development charges. So this concern by SALGA also relates to the previous version of the bill and has subsequently been amended to address this concern. Subsection 9A1C has been removed from the current version of the bill. This version of the bill confirms that the power to levy development charges lies with the municipality. Then section 9A5 and 9B must be collapsed together. So they were proposing that we collapse these two sections, and maybe I need to indicate what these sections were saying, where section 9A5 was saying, unless provided for in the conditions of approval of land development, then a landowner must pay the full amount of development charges prior to exercising the rights that have been approved. And then 9B3 was saying that the policy on development charges may provide for the payment of development charges in tranches in accordance with the payment schedule. So the concern relates to the previous version of the bill. However, it is not appropriate to collapse the two sections, given that section A, subsection 5, relates to the power given to the municipalities when levying development charges as a condition for approving land development applications, whereas section 9B3 relates to the provisions that municipalities are allowed to cater for when adopting their DC's policies. Although National Treasury agrees that the requirement for full payment of development charges before exercising the rights by a developer must remain, the bill still gives both parties an option to agree otherwise, given that in practice, some municipalities still withhold the issuing of a clearance certificate to enforce the payment of development charges. And also this prevents the applicants from transferring the properties to new owners, because this will make it difficult for municipalities to enforce the payment of development charges, as they only had entered into an agreement with the first applicant and not the new owners. The bill has been refined in section 9B4. This was previously section 9B3, to indicate that the policy on development charges referred to in subsection 1 may provide for the payment of development charges in tranches in accordance with the payment schedule for specified categories of land development, which payment is due and payable before developing or utilizing the land, unless the municipality and the applicant agree otherwise. Then there was another proposal that the concept of municipal engineering zones be revised to allow municipalities to have the flexibility to use their development charges according to their envisioned plans and priorities, allowing them to pool development charges for identified projects. So, so the bill has been incorrectly understood, given that the engineering service zones, as outlined in the bill, they are permitted, which means that municipalities are allowed to charge development charges per engineering service zone, but it is not a requirement. National Treasury disagrees with granting municipality the flexibility to use the development charges on their envisaged plans or priorities, given that this source of revenue is specifically for the provision of new infrastructure or upgrading the existing infrastructure. Then, and this provision also guards against the municipalities using development charges on the operations or administration of the municipalities, for example, on paying salaries. Furthermore, the bill requires municipalities separately account for revenue derived from the imposition of development charges, and that this revenue should not be utilized for any other purpose except for the provision of infrastructure, whether new or existing, required to service the proposed land development and for future developments within the municipal jurisdiction. Subsection 95AB, the landowner is responsible for the cost of performing the calculation of such adjustment, which must be carried out by a registered professional engineer appointed by the landowner. So SALGA feels that this is totally inappropriate, as it will then see individuals outside of the municipality calculate the adjustment, which the municipality will have no proper quality controls or oversight over. If the need to be adjusted, if there is a need to be adjustment to the development charges, then they must be done by a municipality and not an external engineer. So SALGA proposes that the subsection be changed to allow municipalities to rather appoint its own professional expert at the developer's cost. So this concern by SALGA relates to the previous version of the bill, and it has been subsequently amended to address this concern. This section has been removed from the bill since both the municipality and the applicant would have agreed to the calculation of development charges before the signing of the engineering services agreement. So we've removed the section that requires the adjustment to the calculation of development charges, because we do believe that the municipality and the landowner would have agreed to the amount calculated for paying development charges before they even enter into an engineering service. So there is no need to adjust the calculated amount. Subsection 9B5, as contained in this bill, now only covers those aspects where a once-off calculation has to be done in relation to a particular application, in relation to the actual impact, rather than using a formula. It is not about adjusting the formula or the basis of calculating the impact. SALGA proposes more clarity as to whether the bill refers to a discount or a subsidy. This concern by SALGA also relates to the previous version of the bill, which permitted municipalities to grant subsidies to categories of landowners or categories of land developments, but it did not refer to discount. Given this concern, National Treasury saw it fit for the bill to be clearer on the distinction between the treatment of subsidies and the discount in relation to development charges. To do this, Section 9E of the bill has been refined to refer to rebates and exemptions, where a rebate then would refer to a reduction on the amount of the development charge payable. And the exemption will mean that instead of paying development charges, the cost of providing the required infrastructure will be set off through the applicable grant. Section 9E has been refined as follows. 9E subsection 1, it says if a municipality has opted to levy development charges in terms of section 9A, it may only grant a rebate for a category of applicants or a category of land development through reducing the development charge payable in respect thereof. Subsection B, exempt a category of applicants or a category of land development from paying development charges where it has set out the criteria for rebate or exemption in its policy on development charges. So the municipality has to ensure that it has set out a criteria for granting exemptions and rebates in its development charges policy before they can grant those. Section 9FA, this section relates to the engineering services agreement. So we had previously indicated that the engineering services agreement must be concluded in respect of any approved land development. So SALGA is of the view that this provision is problematic because the municipality does not enter into an engineering service agreement with every approved land development. SALGA proposes that the word approved must be removed from this section. So National Treasury disagrees with SALGA's concern, given that Section 40, subsection 7B of SPLUMA allows the payment of development charges as a condition for approving land development application. Furthermore, the engineering service agreement serves to protect the rights of both the municipality and the applicant, and also outlines the roles and responsibilities with regard to the installation or upgrading of infrastructure, including the payment of development charges. The engineering service agreement also provides the remedial actions for either party when they default from the terms of the agreement. Section 9G, which relates to the installation of external engineering services by an applicant. Subsection 1 of 9G, the municipality may offset the cost of installation of such bulk engineering services against the associated development charges. So SALGA is proposing that for accounting purposes, each of these elements would need to be considered separately to determine whether it is a revenue, expenditure, asset, or liabilities in accordance with standards of CRAP. Although National Treasury agrees with the comment from SALGA, no changes were made to the bill as accounting and reporting will be prescribed through this act, but will not be prescribed through this act, but municipalities will account and report on development charges in accordance with the existing legislation, such as the MFMA. Then in addition, a guidance on how municipalities should account on development charges will be provided through regulations or guidelines to ensure alignment with the standard of CAP. Section 9H1, SALGA proposes that the condition that the bulk infrastructure should have been installed within the 12 months from the completion date as per engineering services must be revised. So these sections, Section 9H or Section H of the bill talks about the failure of the municipality to provide the required infrastructure. National Treasury does not agree with the proposal from SALGA, given that this section has been incorrectly interpreted, given that both the municipality and the applicant have to enter into an engineering service agreement, and they will both agree on the timeline for installing the required infrastructure, including the extension of the timeline in case the municipality fails to complete the installation with the agreed or within the agreed timelines. So this the 12 month is the 12 month from the completion date. So if the municipality and the developer had agreed that the completion date for providing infrastructure, it's May 2023. So it means that this specific provision then will kick in from July 2023 until May 2024. Section 9L, subsection 9L1B, the last part, which relates to may be delegated to a person in the employ of the service of the relevant municipality. This could have referred to Section 79 of the MFMA or 59 of the MSA. So Section 9 relates to the delegations. So National Treasury disagrees with SALGA's proposal, given that this section deals purely with the applicability of development charges, and neither the MFMA nor the Municipal Systems Act clearly outlines these details. Furthermore, Section 79 of the MFMA refers to delegations in respect of application of the Act, that is the MFMA, and not the development charges nor the Municipal Fiscal Powers and Functions Act. Furthermore, Section 59 of the MSA relates to the process to be put in place by the Municipal Council while developing a system of delegations. Then Section 9I, subsection 1A, a municipality must separately account in the municipal budget and related financial reports for all. There is a referral to related financial reports, whereas elsewhere in the proposed amendments, the term annual reports is used. So they wanted clarity as to whether we meant the annual report. A decision on accounting for any item separately in the annual financial statement is made in accordance with GRAP 1 on presentation of financial statement having regard to materiality, aggregation, and disaggregation. The concern raised by SALGA relates to an old version of the bill, and all provisions related to accounting and reporting on development charges have been removed from this version of the bill, and municipalities will account and report on DC in accordance with the existing legislation. And then in addition, National Treasury will issue circulars or notices to provide guidance to municipalities on how they should account and report on development charges. That was my last presentation on the SALGA submission. Then I'll hand over to Sandra to take us through the rest of the presentation. Over to you, Sandra. Over to you, Sandra.
It doesn't look like she's in the platform.
Sorry, I was just disconnected for a minute. Apologies for that.
Yes, you can continue, Sandra.
Okay, thanks, Chairperson. So I'm going to present on the last two submissions. The first submission is from Ms. Hendrina Foster in Middleburg. So Ms. Hendrina is rejecting the bill for the following reasons. Municipalities are struggling financially, not due to a lack of extra levies, but due to mismanagement and corruption. This extra levy will add to the financial burden already loaded on municipal customers, and the majority of South Africans will not be able to afford this extra levy. So our response is that we do not agree with the concerns raised by Ms. Hendrina, given that the development charges are not a new source of revenue for municipalities. There are already some municipalities that are levying this charge. The general concept of a development charge is that the urban growth and expansion of new land use development create the need for additional infrastructure services. So these services, which are an essential part of land use development, are a direct cost generated by the development and should therefore be paid by the applicant. Next slide. So development charges are based on the benefit principle and therefore payable by individual applicants to fund the provision of infrastructure. The infrastructure that is meant specifically to service their proposed land developments rather than it being subsidized by the rest of the ratepayers in the municipality through the increased rate and tariffs. So the bill, once enacted, it will promote accountability and the predictability that current residents, especially the poor, are not required to subsidize the cost of commercially viable developments. So development charges will provide additional funding so as not to divert existing municipal capital funding away from planned renewal and upgrading projects for existing customers. Next slide. So the next submission, next slide. Okay, thanks. So the next submission is from Kenneth Kaunda District Municipality. So the executive mayor of Kenneth Kaunda District Municipality raised a number of issues with respect to the financing and delivery of the municipal health services function, and recommended that the National Treasury review and revisit the equitable share allocation for the municipal health services function and power, and increase the equitable share to ease the rendering of services at the minimum norms and standards from the 1st of July 2023, this year. So just to indicate that this input does not relate to the amendment of the bill, as it does not deal with the development charges. However, the recommendation by Dr. Kenneth Kaunda District Municipality is welcomed and is already a matter that has been taken up as part of the ongoing work to refine the local government equitable share formula. And this work is being collaboratively undertaken by the Government Equitable Share Working Group, which is comprised by National Treasury, COCTA, SALGA, and with the advice from FFC. This is the end of the presentation. Thanks.
Okay, are we done with all the presentations from SALGA, from National Treasury?
Yes.
Okay. Let's proceed to item 5. Committee members, are there clarity seeking questions and or comments? Okay, it's like it's understood. Let's move to before closure. Are there announcements, Alan Tebogo?
No announcements, Chair, except to say that the committee is meeting tomorrow morning at 9 o'clock again.
Okay. Thanks very much, honorable members. National Treasury, entities that report to National Treasury, support team from Parliament and everybody who was in attendance. Let's adjourn the meeting until we meet again tomorrow at the same time on the same platform. Thanks. The meeting is adjourned.
Thank you, Chair.
Recording stopped.